Bloomberg Audio Studios.
Podcasts, radio, news.
This is the Bloomberg Surveillance Podcast. I'm Tom Keene, along with Paul Sweeney. Join us each day for insight from the best in economics, finance, investment, and international relations. You can also watch the show live on YouTube. Visit the Bloomberg Podcast channel on YouTube to see the show weekday mornings from 7 to 10 a.m. Eastern from our global headquarters in New York City. Subscribe to the podcast on Apple, Spotify, or anywhere else you listen, and always on Bloomberg Radio, the Bloomberg Terminal, and the Bloomberg Business app. I will not mince words. On Global Wall Street, with great respect to Cliff Asness and a few other worthies, there is no one that does the math like Wei Li at BlackRock. She joins us this morning, parchment from Cambridge, but far more acclaim in her China. Wei, thrilled to have you on right now. I look, Wei Li, at where we are, and my question to you is, when you correlate equities, bonds, currencies, commodities, do you see a stable global system, or is there enough instability out there to give you concern?
Good morning. Thank you so much for having me. So when we look at cross-asset correlation, you look at equity bond correlation in the US, you look at equity bond correlation in Europe. They have been going steadily from negative. It's a very challenging for portfolio diversification. We have gone from the period of disinflationary environment to a period of persistent inflationary environment. And as such, duration and the role of duration as ballast in your portfolio construction is severely challenged, which is why we need to really rethink portfolio construction in this current environment to really kind of think about diversifying your diversifiers.
Well, let's diversify the diversifiers, because we know Wei Li bought NVIDIA 3 years ago when I didn't know how to spell it. Wei, how do you diversify the diversifiers with big tech again on this Thursday moonshot?
Yeah, actually, it has been a very concentrated equity market rally in the U.S.
I need to interrupt and say, Wei Li has said, just shut up and own it and say thank you. I want to say that she's been on board. Continue, Dr. Li.
We still like tech. We still like the magnificent, not 7, maybe it's 6, maybe it's 5. But if you look at their earnings, so yes, NVIDIA has done extraordinarily well, up 500% and more since last year, but its forward earnings has gone up just as much, and they're beating those very high levels of earnings expectations. And it's not just NVIDIA, right? You look at tech sector as a whole, it's really carrying the earnings momentum in the US. So we're still very comfortable with our NVIDIA call, with our tech sector call, but we also see kind of momentum broadening out. If you look at kind of margin expansion in the US equity market, 8 out of 11 sectors managed to grow their margins the last earnings season, which gives us confidence behind our US equity overweight. But the AI theme, in our view, has a significant runway to play out as we think about other sectors kind of starting to extract profitability and benefit from that.
Wei Li, we had some central bank movement recently. The Swiss National Bank cutting their interest rates, the Bank of England holding their rates steady. How do you handicap the U.S. Federal Reserve here? Is the Fed maybe behind the curve a little bit in cutting rates here, or do you think they should, in fact, hold steady?
I think this environment where the Fed is later than the other central banks is highly unusual, right? So the ECB going before the Fed, and BOE likely going before the Fed as well. I think this is highly unusual. It's also highly unusual because we're talking about an environment where central banks are looking to cut rates when inflation is way above target, when growth is not really teetering around recession, right? So this is all very, very extraordinary in terms of the environment for central banks, which is why we are of the view that even when the Fed starts cutting later this year, which is our expectation, 1 or 2 cuts for 2024, which is not really contrarian. But even when they start cutting, we're talking about an environment of high for longer. They're not going to be able to cut as much as before to come to the rescue of the economy because of the broadly inflationary environment, given structural forces such as the low carbon transition, such as aging population pushing inflation higher. But even AI, people think about AI as deflationary because of the productivity boost that we are all hoping for. The markets are to some extent pricing in. But before it becomes deflationary through productivity boost, the capex spend, the enormous capex spend, actually means that AI will have to be inflationary first before it can be deflationary, right? So because of all of this, we're talking about high for longer for central banks. That applies to the Fed, that applies to the BOE, that applies to the ECB as well.
Wei Li, thank you so much, and thank you for being in the markets and explaining it to us. Joining us right now, Torsten Slok, Apollo Global Management, hugely read on Wall Street, of course, off of his iconic work at Deutsche Bank, is, well, Torsten, 12 months forward, where's real GDP?
With still mildly hot economy, mildly hot weather, but with the risk that we may have some slowdown coming, maybe 12 months, but more 18 months into the future. The fear you can have is that higher for longer ultimately begins to bite harder on levered balance sheets for consumers, on levered balance sheets for firms, and levered balance sheets in the banking sector. And that could potentially create that dreaded recession that we've been worrying about for so long. But so far, for the next several quarters, we still think that the tailwinds to growth are very strong from fiscal policy and from easy financial conditions.
Torsten, you've been pretty consistent here in your call that this Federal Reserve doesn't really have to cut rates in 2024. Do you still believe that? And if so, why?
I still believe that because what I think, the first test is, well, if we literally just quote unquote look out of the window and see how are things going in the incoming data, non-farm payrolls at 272,000, that's a really strong number. There's some debate about whether some of that maybe is driven higher because of immigration. Wendy Edelberg and Tara Watson at the Brookings Institute wrote a very important paper suggesting that maybe the equilibrium growth in non-farm payrolls is about 100,000 higher than normal because of immigration. But I still think that strength in the numbers across the board. We had a little bit of weakness maybe in retail sales earlier this week, but at the same day, we also had industrial production was very strong. So jobless claims also looking good. It's just hard to see where that slowdown is that so many people are worried about. So because of that, we just don't see the urgency for the Fed having to cut rates.
Are you surprised that the higher rates haven't impacted the consumer more? I mean, it's tough to get a plane seat. It's tough to get a seat on a cruise ship. It's tough to get a seat at a restaurant. Talk to us about how the consumer's reacting.
Yeah, this is very important, Paul. So what I think is very critical in that discussion is that the transmission mechanism of monetary policy was actually working last year exactly as the textbook would have predicted. The Fed raised rates in March of 2022. And the most highly levered consumers started responding because you saw delinquency rates go up on credit cards, delinquency rate go up on auto loans, especially for consumers that have more debt, which generally are consumers that are younger also and consumers that have lower FICO scores. Same thing for corporates. You began to see default rates go up for high yield, default rates go up for loans. So in other words, balance sheets that had a lot of debt were first hit by the Fed raising rates. But what really is unique at the moment, and this is the answer to your question, Paul, is that for consumers, they have locked in during the pandemic mortgage rates. As we all know, 95% are 30-year fixed at very low levels. Likewise, for corporates, the vast majority of credit markets is IG, and IG companies locked in and termed out also very low interest rates. And as a result of that, the transmission mechanism has just been weaker than what it normally is. And that changed with the Fed pivoting to dovish, because then on top of that, not only was the transmission mechanism weak, but we also got a tailwind from easy financial conditions with S&P up as much as we have seen.
Torsten, you've led on this, and it's your best chart of the many charts you put out. 10 years ago, folks, the share of mortgages below 4%, Paul, was 30%. As a force of conversation, it's doubled. I mean, the number of mortgages below 4% has doubled in 10, 11 years. And Torsten, that goes directly into the transmission mechanism. You know I'm very negative on the dots. Do the dots of the Fed, have they adjusted to the Slok slower transmission mechanism?
Well, I do think what is very important in the last FOMC meeting, and you have also talked about that on surveillance radio, because what we saw was, of course, that the Fed went from instead saying 3 cuts in 2024 to now saying 1 cut. That on its own is an admission that we were wrong at the Fed. Right. We thought that we would have 3 cuts. Now we think we're going to have 1 cut. So in some sense, the Fed is coming, quote unquote, back to the view that maybe there is no strong arguments for being in this urgent pace of having to cut rates as quickly as they thought just 6 months ago.
We're thrilled you're with us for the entire half hour. Torsten Slok, when we're going to go to Michael Barr News, but I'm going to really come up on beating this. Folks, I haven't mentioned this on air yet, but it's asymptotic 2024. What is he talking about? Come on, Torsten, all the asymptote discussion. Ethan Harris, retired from Bank of America, leading the charge on this, a few others as well. They're lost, and they're extending out the x-axis as far as they can. It's that simple, right?
I agree. I think that what is very important here is that we have unleashed some fairly significant powers with inflation going up. And one point that's also very critical in this discussion is that if you look at Michigan 5 to 10 year inflation long-term expectations, the median is still very well behaved. So the median household still thinks inflation will be 3.1, which is where it's been for the last several years. But if you look at the mean, you will see a significant increase in 1/2 of the population expecting that inflation is going to be dramatically higher than the other half. And if you look at the sub-questions in the University of Michigan, who is it that's expecting inflation to be higher? It is, generally speaking, the bottom 33% of household incomes, meaning lower income households expect much higher inflation than high income households. And it's generally also people with high school or less education that expect inflation to be a lot higher. So you're beginning to see some divergence in inflation expectations. And this is opening up a very important debate in the Phillips curve that you and I, Tom, had talked about for years, where if inflation expectations for half of the population are very, very high, what does that mean for when the Fed says that inflation expectations are under control? Yes, the median may be under control, but there's a significant part of the population that still worry about inflation.
Torsten, talk to us about what concern do you have about this, maybe the commercial real estate market in this country? It feels like there's still a big shoe or 2 or 3 to drop, but maybe not. How do you think about that risk here as we look around to some of these big cities and see a lot of vacant office space?
I think the important data point first to keep in mind is that the price per square foot for office nationwide is down more than 40% from the peak. So if we think about what that means, that of course means that there's a lot of office that has been reset at a lower level. Now, there's some important differences across the country, of course, with the Sun Belt, with the West Coast relative to East Coast, relative to metropolitan areas. But the bottom line is really that, when an asset price goes down more than 40%, and in particular when the financing of that asset price is something that normally is reset every 5 years, then we still have a maturity wall in commercial real estate, in particular in office, that is really, really steep. For other types of commercial real estate, things look a lot better. So, of course, you have warehouses, industrial, you have apartments, multifamily, shopping malls. You, of course, also have data centers. There's some very idiosyncratic stories across the different types of commercial real estate. But the main issue still that we should all be watching is office, because that is just still where most of the downward drift is.
Torsten, another economic issue that's really been, or I guess this discussion point over the last 18 months as we look around the world, is this concept of American exceptionalism from an economic perspective, the commercial real estate issue notwithstanding. How real is that, the U.S. economy strength vis-a-vis the rest of the world, and how do you explain that?
Yeah, this is really important. So there is a structural discussion exactly about, is the U.S. exceptional? And the U.S., of course, is exceptional because of large capital markets, much more spending, and broadly speaking, across the board, including on defense, including also on the role of the U.S. consumer. So simply because the U.S., as the biggest economy in the world, playing this very substantial role, it does, generally speaking, attract capital. On top of that comes the more cyclical arguments, namely that the U.S. business cycle just happens to be a lot stronger than the business cycle in Europe, the business cycle in Japan, Canada, Australia, emerging markets, and of course also China. And when the U.S. is stronger, then that means, of course, as we're seeing and as we're talking about, then rates will be higher for longer in the US than elsewhere. That's, of course, what we saw with ECB cutting rates. The Bank of England today staying on hold, but now signaling clearly that rate cuts are coming. All that argues for still more upward pressure on the dollar because the US is exceptional, not only from a structural perspective, but also at the moment exceptional from a cyclical perspective. So with that backdrop, when will that exceptionalism from the cyclical perspective change? When the Fed begins to cut rates, then we could begin to see the dollar begin to turn really south in a much more substantial way. But given that's still now being pushed out repeatedly, then I still think the dollar will be going up, and the exceptionalism does play a very important role, both on the structural side and on the cyclical side.
Torsten, one more question. We've got to go to breaking news, but I think this is too important. Back to the idea of an x-axis that goes out forever, and the new idea percolating of an asymptote, I guess down to 2%. Is the asymptote a smooth glide path down to 2% out there somewhere, or is it 2.x%?
So if you mean inflation, of course, then the issue is that inflation at the moment, as you know, is 3.3. The Fed's target is that it should be 2. 3.3 is not 2, so that's why FOMC members repeatedly talk about, well, maybe we do need to wait a little while longer before we start cutting rates. And to your question, will we have an asymptotic move down from 3.3 to 2.0? I think that the answer to that is absolutely not. We still have significant tailwinds from fiscal policy, the CHIPS Act, the Inflation Reduction Infrastructure Act, are all policies that are designed to lift growth over the next several years. Likewise, we have a very strong tailwind from easier financial conditions. As long as the AI story and the stock market goes up, we still will have, like we saw this earnings season, strong demand for airlines, hotels, restaurants, concerts, sporting events. So the short answer to your question is, I worry that inflation is not going to come down in a straight line to 2% from the 3.3% where we are today.
Torsten Slok, thank you so much. Okay, what we're supposed to do here is give Anastasia Amoroso of iCap a massive victory lap 9 months ago, whatever. Just shut up and get in the market and buy big tech. She absolutely nailed the 2024. We were talking about AI, and you are the Chat GPT queen. I mean, let's be honest here. You're glued to it. How do you use Chat GPT? For our entire audience, it's like, what?
Well, it is a game changer, and I think it's a huge productivity boost. And if you haven't used, not that to make any product endorsements here, but if you haven't used the Microsoft Copilot, I think you're really missing out the next wave of how search is going to be done. And whether it's preparing for an interview, whether it's preparing for a client meeting, whether it's needing a quick synopsis of a particular topic, it is amazing what you can do with about 5 seconds worth of time.
You need to create 7 pages of iCapital brilliance. You're at O'Hare. Your plane's delayed 2 hours. You're on a laptop with ChatGPT. How does it help you create that research note?
Well, first of all, it's a quick prompt. It's a question that you ask, please generate 500 words, and here they are. And by the way, I have done this. I do not publish the ChatGPT as the research, but if I need a quick synopsis of a particular topic, that's the perfect way. I also do happen to do a lot of interviews with a lot of our asset managers, and what a great way to prepare and know the key points going into it, whether it's about the firm, about the investment strategies. So I think you can use across.
What's great, Paul, when Anastasia is at O'Hare, she's at Stanley's Blackhawk Kitchen and Tap. She's using ChatGPT to get the correct craft beer.
So Anastasia, how do we bring that into our investment thought here? I mean, because for really 18 months, AI has been one of the key themes driving this market higher. Is that justified in your minds? Are you kind of, as an investor, all into that story and looking for ways to play it?
Yeah, I think it's 100% justified. And I know a little bit before we came on air, we were talking that maybe not a lot of people are actually using this across their functions right now, but I think a lot of people will in the future. I think what's happening right now is the race to invest in artificial intelligence by hyperscalers, but also by other companies, across different industry verticals. I think there's a great realization by companies, if you're not going to focus on investing in AI now, you are going to be left behind. So why would you continue to hire the same amount of workforce when you can automate certain tasks and boost your margins? So I think that's a universal sort of understanding right now from corporate development departments, and that's what's driving the investment cycle in artificial intelligence. That's why I don't think it's a coincidence that the likes of NVIDIA and Broadcom and actually a whole suite of semiconductors are benefiting from the build out of the backbone of artificial intelligence. Do I think the momentum is a little bit stretched at this very point? Do I think some exuberance crept into a stock like NVIDIA? Yes, but at the same time, if the data center sales are growing 400% plus year over year, that's fundamentals.
So, all right, so NVIDIA, check, I got that. How else are you suggesting to your clients that they maybe get some exposure to this, if it is in fact a long-term trend?
Yeah, it's a huge trend. And in fact, the total addressable market for AI is going to double in the next several years. And it's comprised of, a couple of different pillars, which is, of course, the hardware, the semiconductors, but actually the biggest chunk of who's going to benefit from AI is software. And it makes sense why everybody is chasing the semiconductor trade, because you have to have the chips in place in order to train the algorithms.
Okay, we get that.
Well, once you do, Tom, what are the applications going to be beyond the co-pilot that are leveraging AI to boost your productivity?
So I know this is brilliant. I know you're not going to talk about individual stocks, so I'll bring up Adobe is the kind of software mix as well. Take the 50 Adobes out there. Where do you see their income statements in 5 years?
Well, I think they're going to reflect the benefit of artificial intelligence. One thing, Tom, that's recently happened to software, it was everyone's favorite sector just a bit ago, but now that's not the case. For example, you have seen software revenues grow at 20-25% per year back during COVID times. That has decelerated to about 10% today. And valuations have derated very meaningfully. But I think that's an excellent entry point into a lot of these software stocks, because to your point, 5 years from now, that's what's going to catalyze the next growth wave in software is monetizing AI.
A derating, Paul, is Anastasia speak for south.
South.
The stocks have gone south. They've derated.
Well.
Lisa, throw a brick at her.
Well, to be fair, some of them have gone sideways, some have gone south. But if you look at the multiple, it went from 20 times to 5. And that's back to those pre-COVID normalized levels. So that's why I like that as an entry point.
Adobe growth, 22% in the heart of the pandemic. Revenue growth right now, 11%.
Yep.
It's cut in half.
Absolutely. All right, so what I hear a lot is U.S. versus non-U.S., big cap versus smaller cap. But still, some of the valuations in Europe still seem so attractive. But I guess the concern is you just don't want to get in that value trap there. How do you think about Europe and opportunities there?
Well, I think you have to look at the valuation, but you also have to realize what the catalyst might be. And for the last couple of years, it's been really tough in Europe because you've got higher electricity costs, you've got meaningfully higher mortgage expenses. And now I actually think the peak pain of high mortgage rates is behind us in Europe. And I don't just mean because the ECB is cutting interest rates. I mean, a lot of mortgages in Europe are floating rate mortgages, depending on the country, 70 or 80% of them. So that's a lot of, pain that the consumer had to absorb, but that's turning the other way around. And so I now think the real disposable income for the European consumer is likely to grow in this year and next. And business confidence, French elections notwithstanding, has recovered quite a bit. So I like the valuation, I like the positioning, and now I think we have the summer of Europe catalyst.
So what is the iCapital new money allocation right now in the American market?
For the public markets, what I would say is don't chase the AI trade right here, right now. Let's see a little bit of a pullback, but I would be reallocating to parts of the market they have seen some consolidation, Tom, and that's consumer finance, for example. I think the consumer is just fine as an aggregate. I would be looking at consumer discretionary, financials, as well as industrials. That's the public market side of it, but to your point, the other big part of the allocation is within the private markets, and looking at things like growth equity, buyout, private equity, private credit, and of course infrastructure. That's where we see some of the flows going.
This has been great. Thank you so much for the chat, GPT. I've never used it.
Try the Copilot. That's the game changer.
Try Copilot.
I'm signed up for it, but I've never used it.
Matt Miller's
Give it a
all in
try.
on the chat GPT.
Dear ChatGPT, how to get afterthought to empty the dishwasher.
Right.
What are they going to say? Anastasia, thank you so much for
Thanks so
iCapital.
much. Ah, yes, I love this. It's because it's about the finance bros. They're not 6'5" or they have blue eyes, but they are sparking a popular dish specifically made for them at Chipotle, okay? It's called the Chipotle Boy Bowl. It's double chicken and it's white rice, okay? And it's Chipotle says it's specifically for them because they put out this post and
It's for finance guys.
Yes, it's for finance guys. It's called the Chipotle Boy Starter Pack because they showed a picture of it on X and it had aviators, AirPods, MacBook, a glove box full of Chipotle napkins, and yes, the popular puffy vest that apparently they all wear. So
Sassauer wears that. It's July. It's like a heat wave, and Damien's in the Patagonia puffy vest.
So they're saying these guys have sparked an interest in this particular bowl with the double chicken and the white rice. So they decided to make this limited time edition just for them. But you have to go to the app to get it. It's the only place you can get it. But,
you have to be digital to get it.
Yes, you have. You can't. Yeah. It's not on the menu posted in the restaurant. Nope. You got to go in the app.
What's
and
it
get
called
it.
again?
It's called the Chipotle Boy Bowl.
The Boy Bowl.
For the finance bros.
They didn't call it the Trust Fund Bowl because that's what you have to go. You go to Sweetgreens to get like 4 meals for the kids. You need a trust fund.
Yep, exactly.
To check out. Next.
Not for that. This one's a deal.
I like the music. Do that more often.
I know.
Can you give us that beat again?
He likes it. He likes it. It's a good little,
Next.
All right. Personality hires. This is the latest workplace trend. So they're going away from skills and they're going to personality. So what we're talking about with personality hires, those have like that certain charm, that je ne sais quoi. They know how to talk to people. Yes, they're warm and fuzzy. They're saying because camaraderie is hard because of the hybrid schedule. So what's happening is that it's causing this animosity with the coworkers because they're saying they have to pick up the slack for these personality hires because they're not doing enough work. So it's this tension now in the workplace that's happening because of these. You're trying to hold your tongue.
Can we do the show next week from HR? It's a sensitive topic, to say the least.
Correct.
And I would say it's out in the literature. It's amazing how there's a lot of major shout out to Stanford University, who's really thinking about this, but there are many, many others. I mean, there's a lot of cross currents here.
Okay.
In the dead of summer as we go to the launch of the business seasons. You're killing me here.
I know you're.
Can I do a remote? Can we do if I'm up in HR, can we do a Zoom remote for the show? Lisa, go away. What do you got next?
Okay, Taylor Swift. She's sparked. Everything. When she's at football games, the ratings go up. When she's everywhere, everything sells out. She's helping out the economy in certain countries. Yeah. Okay. So now the Washington Post is saying TikTok is building this entire in-app experience around Taylor Swift. So users, they can get these digital profile frames. They have these in-app friendship bracelets. And if you complete certain tasks, you get the all limited edition Swift-themed profile frame that everyone wants.
From your prism, and we cover this, I think, on Tuesday as well, where the social influencer thing sort of is off the bloom. Mm-hmm. Are the kids as glued to the social influencers like they were a year or two ago?
Oh, most definitely. I mean, that's how, I hate to say, but that's how my daughter gets all her beauty products, is from watching what these other people post. But it just goes to show you that they have the influence. Swift has more than 32 million followers on her TikTok account. Right. But it does spark this cause for other people to buy products or to want things that they want. But here's the thing, you have music producers who are saying that it's taking away from the emerging artists who are trying to get on TikTok. But, I mean, emerging artists, Taylor Swift, it's hard.
I remember, I had the clearest memory when she was an emerging artist. I mean, people forget that she was there. She did a thing. She was, Paul, I think 16 years old.
Amazing.
And came out, Def Leppard's playing, and this tall blonde girl comes out from the back. No one knew who she was. Who is this? And she had like one country hit or whatever. And she was literally, I think, 16. And it was.
And that's how it started.
To see her and Joe Elliott work and the rest of Def Leppard, it was like, who is this? This person is different. That's it. The newspapers today. Lisa Mateo there.
This is the Bloomberg Surveillance Podcast, bringing you the best in economics, finance, investment, and international relations. You can also watch the show live on YouTube. Visit the Bloomberg Podcast channel on YouTube to see the show weekday mornings from 7 to 10 a.m. Eastern from our global headquarters in New York City. Subscribe to the podcast on Apple, Spotify, or anywhere else you listen, and always on Bloomberg Radio, the Bloomberg Terminal, and the Bloomberg Business app.